Swayam Prabha. Digital India. Educated India.
Hello, this particular session is a part of economic, industry and company analysis. It is known as EIC analysis in a security analysis context. We have discussed earlier about economic analysis. We started the industry analysis in the previous session. Let us recapitulate what we have discussed in the previous session. We talked about why one should go for industry analysis, what is the importance of that, what is the advantage of going for industry analysis. We also talked about different market or financial performance, like different industries give different return on in the market, and they have got different accounting rate of return also in a particular period of time. And we talked about the basic steps involved in industry analysis. Subsequently, we talked about the concept of business cycle and industrial sectors. We saw that in different cycle, different part of business cycle, like a recessionary period or a booming period, we see that different industries perform different way. So, an analyst has a challenge to find out which particular industry is likely to do better in the subsequent phase of business cycle. Accordingly, the analyst can switch from the one industry to another industry, or suggest the investor to switch from one industry to another industry as such. So, there is a possibility of industry rotation looking at the business cycle as a concept, and if one can figure out the trend in that, nothing like it in a analysis framework. Now, in this session we are going to discuss about the industry life cycle, where we talk about how the products go through different phases of its life cycle. It gets introduced and then grow, then it decline at the subsequent time. No company can produce certain goods and can produce as such, but can market the goods products for that matter for all the time to come. Products get introduced and they again come to a decline stage. So, no product is going to be there for all the times to come as such, and so companies have the challenge to switch from one product to another product depending on the type of products they have the portfolio. And next we talk about in this session is Michael Porter's 5 forces model. There is a very famous framework to analyze the particular industry. Then we talk about the different valuation measures with reference to industry as such. We talked about company valuation, and you look at the industry valuation. From there also you can go to company valuation for that matter. Then we will also talk about the global industry analysis context. What are the things that special things to one has to take care as far as the global context is concerned, because industry these days is not specific to a particular country, rather it is affected by different things across the world. Different companies source different materials from different countries for that matter. They have got different customers across the world as such. In that case, industry analysis has to also look at the global context. And coming to the one of the tools in industry analysis, we use something called industry life cycle. And in industry life cycle, we say the company the particular product gets introduced, and it is called startup phase. This is a 4 phase, one of the 4 phase industry life cycle as such here. Then you have got introduction stage, a startup phase, where you see that rapid and increasing growth. Then we have what is growth stability is there, then the growth slows down and there is an accelerated growth here, then the growth minimum growth or lesser growth, or there is a negative growth or decline that happens. Any product in a particular context will always go through such phases, and products get introduced, products also grow in terms of sales, and then subsequently products have got to decline, as no particular product is going to be there for all the time to come, accepted by the consumers at large. Now, going to the different stages here, we see here in a startup phase, we will see that there is a very rapid and very high increase in the growth in the revenue, and possibly we will have few number of players also in that. Then we have got the consolidation phase, then you have growth stabilizes, then we have maturity where the growth actually slows down, though the growth is there, but the rate of growth is much lower than the previous phase. Then we have the declining phase, a relatively declining phase, where you say the least amount of growth is there, or there is in fact there could be a negative growth in the products sold by a particular industry together, or even for the particular company for that matter. So, this is becomes high time where one has to switch to another product, or before that itself the new product should have been introduced by the company or by the industry in the market as such. Now, coming to the another alternate approach that we have in industry life cycle, the instead of the 4 stages that we talked about in the previous section, here we talk about the 5 different stages of industry life cycle. The first one is called the pioneering development, where you have got the limited amount of sales, but and at the same time you have got low profit margin or lower profit margin, because at this particular point of time huge cost is involved, huge capital expenditures are involved, big amount depreciation will be there. So, there may not be as much revenue to take care of the cost. So, it is quite likely that there will be a lesser amount of profit margin, or maybe a negative profit also is quite possible in the initial phase as such. And we will see that very few number of players are there at the particular stage, but subsequently what happens when the market knows about this, then the product, and similarly when the companies achieve the economies of scale, economies of scope for that matter. So, they have got a high revenue, and they also have got recovery of cost with different larger production base, and the cost per unit also declines in profit margin because very high during this particular stage. Still, so that is called the rapid accelerating growth, and there are very high sales growth, we will have very limited number of competitors, and at this point in time also very high profit margin, because the sales is very high and the cost per unit could be much lower compared to the previous cycle phase. And in this we will have high, and we will also have limited number of competitors there. But looking at this particular attractiveness of particular industry in that particular stage, new number of players are going to be attracted to this particular sector at this point of time. So, what will happen in that case, once more number of players come into the market, there will be a lot of competition with the price also. The price competition takes place. So, in that case what will happen, the profit margin is going to be lower, because the price itself is going to be controlled, and there are several players where this a lot of competition comes to the phase in the next phase called the mature growth. So, there will be high profit margin could be there, but the profit margin is going to decline over a period of time as such. So, because the number of players are more and price competition based on the price is very high at this particular phase, and then what in this stage also we have this normal sales growth higher than the normal sales growth. When you say normal sales growth, we talk about that the overall economic growth whatever is there, and higher than normal means the particular industry is growing at a higher rate than the economy. If the economy is going to let us say growing at 8 to 9% during particular period, at that point of time this particular industry may be growing at some 10, 12, 15% as such. So, there is a lot of growth opportunity still there, and it is increasing growth is more than the economy growth as such. Then after the mature growth we have got the stage called stabilization and market maturity. At this point of time as many competitors have come into the market, and this particular phase is supposed to be a very longest phase in the industry for that matter, and we will have normal sales growth here, which is almost same as the overall economic growth as such. And since as many number of players are there, the best possible price is there available for the customer, that means least possible price offered by a particular competitor to stay in the market, then in that case we also have the lowest profit margin. There is a profit margin definitely there, and but there is a lower than the previous period. So, at this point of time this particular industry, particular product or industry loses its attractiveness, and possibly new things might have come in the overall market, where the products sold by the industry in that particular time period may not be that much appealing or catering the customer requirement. Customers might have shifted to some other products, and that may be more attractive. So, that point of time what happens next stage is the deceleration of the growth or decline in the sales growth, that the last phase where the decline takes place. There will be a very low profit margin during this particular phase, and there is a There could also possible there is a negative profit margin, the company is maybe making losses on that particular product in that particular industry, and obviously this is going to be very high, very low return on the capital invested. So, obviously there is no point in investing in a particular company which has got products in the declining phase. For that matter, at the time of stabilization phase also there is no point in introducing there. Looking at the utility of this particular analysis is that the analysts should look at those industries where the lot of growth opportunities are there, particularly during your mature growth, or maybe not mature growth, but before the mature growth, the rapid accelerating growth. This is the time where the analysts should, one should enter in that particular sector and invest, so that they have the best possible growth there, best possible profit margin, and one should reap in the benefits of introducing there. And once the particular company or particular industry comes to a stabilization phase or maturity stage, it is time that one should look at exiting for that particular industry. So, this is the one of the utility of the industry analysis, is a very beautiful tool as far as industry life cycle is concerned. Now, we move on to the next method of industry analysis, where we talk about the Michael Porter's 5 forces model, popular known as the Michael Porter's 5 forces model. If you look at this model, it says that what are the different forces that drive the industry, in any industry for that matter. There are different industry things that affect the performance of industry as such, like one of the potential entrants are there, they are going to affect the industry here, what is competition, and the industry itself, there may be a lot of rivalry among the existing firms, and they may be affected by the potential threat from the new entrants. There could be also pressure from the buyers, there could also be pressure from the suppliers. The suppliers may have a very high bargaining power, then this particular industry loses its competitiveness possibly, or the buyers may have the higher bargaining power, that could be also difficult proposition for the industry, and there could be a threat of the substitute products or services, whatever products are being sold by this particular sector's industry, the products may be available in some other sector, some other substitutes could be available. So, then this particular industry may not be that much attractive. So, all those factors that we discuss here, as Michael Porter has suggested, there are several things which are part of this, like bargaining power of buyers, or threat of new entrants, or the rivalry among the existing firms in the particular industry for that matter, or suppliers, or different threat from different substitute products. There are multiple things that affect as a set in a particular one of these 5 things that we have in Michael Porter's 5 force model. So, we are going to discuss one by one what are different things that is there as far as different forces are concerned in the industry analysis. First, we move on to the threat of entry. Now, obviously, this is very simple concept, that as long as the return on investment is more than the cost of capital in any sector, we talks about return on investment, return here, and where we talk about the cost of capital. What do you mean to say that if there is a particular company which is earning a return on the investment, and whatever the borrowing rate is there, or the overall cost of capital is there, which is overall cost of capital depends upon the equity as well as the debt or other source of finance, as long as this R is more than cost of capital, and that means the industry is an attractive proposition for that matter. So, every time an investor look for that opportunity where the return is on more than what is expected by the investors as such. So, that is an attractive proposition. So, as long as that particular phenomena is there, that particular industry is going to attract lot of players in the market as such. The moment lot of players come to the particular industry, then the competitiveness of the particular products may still be there, but since number of players is very high, good number of players are there. So, the lot of competition is going to happen, and in that case what will happen, the price whatever the company is able to charge a particular very high price at this particular point of time, since more number of players are there, the price is going to be charged now is much lower as such. Now, one has to see that what is the threat that in this particular industry face, the players in this particular industry face from the other outside agents, outside players who will like to enter this particular market, and the threat may be very high, the threat may be low for that matter, depending on different things like this. So, first thing that we talk about in threat of entry, how bigger is threat is that we have got something called economies of scale. If already the particular companies in the particular sector has spread across and lot of activity has to happen, so that you got the least cost production as such, then for another company to come and establish a particular unit in that sector and having a bigger operation is going to much difficult as such. So, if that is the case, if the higher economies of scale has to achieve, then in that case for the new entrants this becomes a very bigger threat as such, because already established players are there who have got large scale of operation. Now, one has to come to that particular level of higher scale of activity as such. Look at telecom sector, when you got the companies have got pan India license as such. Now, everybody has, almost all big players have got the pan India license. Now, one new player also has to get a pan India license and spread across the country, then only the particular new players telephone service can be little more competitive, as can at least can throw a competition in the market as such. That is one. Then second thing that we have in case of threat of entry is something called absolute cost advantages. When you say absolute cost advantage, the existing or the incumbent player in that particular industry has got certain advantage over the cost for that matter. For instance, when the oil fields are auctioned or the exploration takes place, so that you can one can go for different river basin or the sea for that matter, offshore for that matter. So, what happens, the companies goes for the booking of this oil, potential oil fields for that matter. If they achieve that particular oil there, they strike that oil is there, or let us say the mining company, they go for having lot of mines in their hand. So, what happens, this particular companies have got a very huge raw material advantage in terms of cost. So, they are already existing there, they have already got the license to explore, they have already got the license to get the mines there. So, they have got themselves a very lot of cost advantage. Now, any new entrant coming to this particular industry will have to depend upon the existing players who will have to supply the raw material for them as such. It may not be possible to access those raw material as such. So, the existing players have got a lot of absolute cost advantage, they are the least their procurement cost of the raw material is going to be much lower than what the new players are going to come and procure the raw material, but possibly they have to procure the raw material from the existing existing players in the industry itself. So, if that is the case, then it becomes a major threat for the new entrants. If this is not the case, if the company do not have those advantages, then it becomes a lesser threat. So, it will be easy for new entrants to come into this particular market and force a competition or throw a competition in that particular sector for different companies already operating. Then there may be certain industry which has already in the industry where you have got a lot of capital requirement, lot of huge investment has to take place, like maybe the company to enter in this particular sector has to pay a huge license fee like a telecom sector, or he has to one has to go for a huge R&D development for like for a pharmaceutical sector, or one has to go for a very good knowledge pool, like one has to got a lot of patents and copyrights, trademarks for to operate in like a knowledge based industry. And or if it is a banking industry, then you have to have large number of network, and in that case you have got large amount of capital to be infused for that matter. If that is the case, a large amount of capital is required for setting a new unit in this particular time in a particular industry, then that becomes also one of the threat for the new entrants, and the existing players are going to get a advantage over the potential new entrants. And as long as the threat is less, threat is not there from new entrants, then this industry can have a better price in terms of the company's point of view. They can charge a higher price because there are few players available in this particular sector at that point of time. Next, we have got something like a product differentiation. Product differentiation means the as long as the products sold by in a particular industry in a particular point of time are different from one to other, then it is better, because product differentiation comes because of lot of R&D input, lot of advertising input. One can look at a soft drinks company, it has got simply something which has to drink, one has to drink for that matter and consume, but the company has got multiple soft drink products as such, and each particular product has got different clientele base, different target types of customer, and each particular software drink we have soft drink for that matter has got a lot of branding happening there. We have different brand ambassadors for different soft drinks for that matter. So, as long as the products are differentiated, different products are there, then for another new entrant to come and play in this particular market is going to be difficult, because the new player has to put a lot of money in branding and having new things to compete in the market as such. If the products are not differentiated, they become something like a commodity and which can be produced and sold by anyone. So, if the product difference is very high in a particular industry, then threat from the other competitors is very going to be low. I mean, there is a chance other people can come, there is a entry barrier from this particular industry as such. Then we have got next is the access to distribution channels. Sometimes what happens, a particular producer may have access to different lot of retail outlets, retailers in the country as such. Now, they have already got the access, any new competitor if is going to produce and sell and also like to have multiple access points, and number of access points is very widespread, geographical spread has to be there. They also may have to look depend on the existing retailers as such. Looks like let us say the shopping malls like Big Bazaar, Super Stop, and they have something like that, or the malls for that matter. So, now the existing malls may not like to have another product of the same category unless they have got certain advantage from the new player to be offered as such. So, this since the particular new old player has already accessed the geography, accessed the space. So, it may be difficult for the other companies, the new players in that particular sector to enter and through a competition against the existing players. So, the access to distribution is very high, it is better. Then in this we have another point called government and legal barriers. There may be for some reason could be one extreme that the particular government in that particular industry is favoring to a particular group of companies, or for whatever reason the government itself has got certain barriers, like in case of FDI restriction or a licensing for that matter. For instance, in the banking industry is concerned, it is not that anytime anyone can set up a bank or have a new bank in this country for that matter. The particular new entrant has to go for a license from the Reserve Bank of India, and different other formalities also have to taken care. Unlike setting up some other industry like cement industry or steel industry for that matter, there the government restrictions are much lower as long as setting up a new entry is concerned. See, the government restrictions are very high, and for setting a new in a particular industry, in that case the existing players are going to have advantage over the potential entrants, because potential entrants could have a barrier. Another factor could be that the government itself could be favoring a particular group of industry at that point of time, which may not be a desirable thing, but it could be actually possible. And once that happens, then for the new entrants may be actually difficult, or new entrants has to make a inroad into the government system, so that their potential units are actually approved to be set up in this particular sector. Then having heard these points that different threats of entry could be there could be another threat of entry, that the existing players can converse together, they can collude with each other, and can also throw a competition in the different form by possibly reducing the price they offer for the product they are selling as such. So, in this case what will happen, the new players may go for a step back because they may not be expecting that suddenly this existing players will reduce the price maybe by 30% or 40% for that matter. So, the customers may not shift from the existing players to new players as such, because new players may not be able to charge a very low price as the existing players have now charged as such. So, that could one can see here there could be lot of price, particularly in the telecom sector one sees here, the moment the new players come, they themselves charge very low price looks like. Then what happens, other competitors also offer some such price as such. We used to have very high call rates Now we see call per second and those things have come up, and you have seen that typically the very truly that the call rates have gone down substantially, and so both the new as well as existing players are resorting to a very cheaper call rate as such. But this is one where all the players are doing, but there may be some other sector where looking at the potential new players, the group of industries they join together, and so that they can have a threat towards the new players or the potential competitor who are going to set up a new unit for that matter by reducing their price. So, there is a retaliation strategy by the established players. Next we have the next category, how much is the rivalry in among the competitors in a particular sector that is at present there. So, sometimes the rivalry could be intensive, then it has got different things to talk about. If the rivalry is not there, something else is going to happen. So, what happens in this case we talk about is the concentration, what is the concentration that is there in a particular sector. When you say concentration, the concentration is very high. When you say that, that means there are very limited number of players in this particular market. So, there is a lot of there is a limited number of players are in the market, then what happens, the all the companies can join together and possibly rule the market as such, and they can have a particular price which will be defined by the group as such. If the concentration is very low, that means lot of players are there in this particular product, in the particular product space or the industry, then there will be very difficult, it will be difficult for them to come together and set the price for the market. So, in that case, if the concentration is very high, that means limited number of players are there, the companies can collude with each other in that particular industry and set the price for the market, and they can continue to have the advantage over the other players, potential players for that matter. So, so that concentration which is high, it may be beneficial for, it may not be beneficial for the end user of the products, but is beneficial for the producers as such. So, lower concentration means the industry may not be that attractive for that matter. Similarly, we have got the diversity of competitors. It is not that the companies are there, small number of players or a good number of players are there, but how diverse are they? Are they selling the same one single product, or are they selling different products in that particular sector? Single product may not be achievable because the new products can come up. So, if the diversification is high, then it is also going to be beneficial for the particular sector as such. So, it should not be that one single product is sold in the particular sector, and diversified products should be sold by different players in the particular sector. And extension of this diversity of competitors is that the product differentiation, as we discussed earlier also, the product differentiation has to exist, there has to be different products to be sold. Let us look at the mobile handset for that matter. It is not that there is only one type of handset available, there are different products, different handsets are available in the by one single company. There may be limited number of players producing and supplying them, but the same got different products. If these mobile companies producers, they were used to produce only single or maybe one or two handsets for that matter, it will be very easy for new players to come and produce the same thing. As the moment they have got multiple products as a diversified things they have, which caters to needs of different consumer segments, that is going to be beneficial for the industry as the existing players. So, the product differentiation has to be there, one product has to be different than the others in something. So, next we have got the condition of excess capacity and the exit barriers. When you say excess capacity, the excess capacity is that particularly we feel at the time of recession as such. Now, there could be a problem there is a lot of excess capacity during recession. The recessionary period is going to be very longer duration. Companies with having excess capacity are going to have huge losses, because they have to have certain fixed cost to maintain the higher capacity level, and it may not be if it is possible for the companies to exit from this excess capacity, and there is no exit barrier for that matter. Because for instance, if the company has got lot of workforce, and then there is a recessionary phase and the workforce they have to will retrenched or they were removed, there may be lot of employee liability could be there. So, exit barrier in that case is going to be very high assets, the company may not be able to exit assets. If this is the case, then this particular industry is not an attractive proposition as such. So, it should be possible that during this particular phase where you have got excess capacity, one should get rid of the capacity how quickly, and the exit value also has to be very less to exit from that. Then we have another factor in this, in the rivalry between existing players. We have got certain companies which may have fixed cost high or variable cost high. There may be some players who have got very huge fixed cost in proportion to total cost. There may be some players who have got lesser amount of fixed cost. Actually, the presence of fixed cost that we have discussed in some of the earlier sessions of this course, and the presence of fixed cost leads to a concept called leverage, and presence of fixed cost in the operating cost is known as the presence of operating leverage. So, high fixed cost is good, and high fixed cost may be good in the case of when you have got a large number of units to be produced as such, then you can recover that, and per unit cost is going to be lower and the variable cost is likely to be lower in that case. So, in that case what will happen, every unit sold after break even point is going to give a huge contribution, a very high profit or contribution margin for that matter. So, high fixed cost is good as long as the demand for the particular products is good, and one can achieve a lot of economies of scale and produce the things at a cheaper price, cheaper cost. So, that is going to be beneficial, but if the condition of the industry certain becomes bad, then companies with high fixed cost are going to suffer like anything. That is one thing also one has to look at, how much is the operating leverage of the particular company or the industry for that matter. That is one thing. The cost conditions could be favorable depending on the condition in the economy, and condition economy is bad, then high variable cost is going to be actually beneficial, because once is high variable cost is there, the company can stop producing and save cost, but the high fixed cost is there, even the company stops producing the particular goods, it has to go for paying the fixed cost as such. Then we go to the next category of industry analysis, that is we talk about the pressure from the substitute products. And so what happens, there may be one particular product which could have other substitutes to take care of that. So, in that case what is the propensity of the buyer to substitute? Can there be something, let us say our industry produces certain things and which can be substituted by some other new products going to come in some other sector for that matter. In that case, if the high substitute is going to be there, then it is going to be difficult proposition. Particularly in case of chemical industry, you may find that will be alternate chemicals may serve the same purpose. So, if for some reason a particular chemical is more costlier for the buyer to buy, they may go for a substitute chemical available elsewhere in some other industry for that matter. So, similarly, there could be other substitutes where the price of this substitute is going to be much lower, and not only that the substitutes available, the price also should be competitive. It should not be that because it is available one can switch to another substitute, the price has to be little competitive, otherwise the substitute should also perform the same way as our particular products are taking care for our customers for that matter. So, in that case if that is not the case, the substitutes are not going to perform well as far as our products are concerned compared to our products, then the substitute has no advantage as such. But the industry has to look at the substitutes are available or not, and the moment the substitutes becomes available, the industry has got a challenge to make their product more cost competitive, means producing at lesser cost and supplying to at a lesser price to the customers. Otherwise, they will cease to exist in the market, because substitutes are going to replace these things as such. Then we have got another type of force, that is called the bargaining power of buyers. When you say bargaining power of buyers, we say that the buyers as a whole have got a lot of bargaining power. It is somewhere, if the supplier or the producer of the goods depends more on the buyer, and for some reason is not able to price a particular product as per the supplier's wish, rather the buyer's wish is taken care more than that, then the buyer has got a lot of power and there is a threat for the existing industry as such. So, when you say bargaining power of buyers, we talk about different things. They are first thing we talk about the size and the concentration of buyers relative to the particular producers as such. If the number of buyers of the products sold by a group of companies in the industry is very limited, that means no other buyer is going to be there, then it what happens, this particular supplier depend upon only that particular buyer, then that means the buyer has the advantage than the supplier as such. So, that is the case, it is going to be difficult. If the number of buyers are going to be diverse, more number of players are going to be there. So, it is may not be possible for one single buyer to rule the market or the dictate the terms and conditions for these suppliers. So, that is one thing one has to look at. If for some reason only few players are allowed to operate in the particular sector and whatever they are going to demand, that is going to be taken care, then it is going to be a disadvantage condition for the suppliers as such. So, then we have got another thing that is called undifferentiated products. So, that means the moment we say undifferentiated products, it may be very easy for the buyer of the particular product to go from one company to another company, and because the products sold by different companies are not different, they are actually same. The moment the products are actually different that one is sourcing, then switching from one product to another product may be actually difficult, or maybe there may be some of the cost also could be involved for the buyer as such. So, as long as the concentration, as long as the products sold by the competitors are differentiated, then the bargaining power is going, the buyer is going to be lower. If they are going to sell the same thing, as we discussed, the undifferentiated products means there is a commodity being sold, and commodities being sold mean anybody can produce and anybody can also source from anywhere as such. In that case, the buyers may not have any problem from switching from one thing to another as such. Similarly, the buyers may have certain switching cost. For instance, if the buyer is using this particular material, could be a chemical, could be a particular metal that is given a particular industry, particular another supplier, and as far as that is concerned, a particular type of machine, particular type of factory setup is there. Now, switching from this particular one product to another product and one supplier another supplier may be difficult for the buyer, because the buyer just to stop sourcing particular product and go for another product as a raw material or as an input has to also go and change the entire setup of the facility. So, in that case switching cost for the buyer is going to be very high, and similarly there could be also penalty clauses that you one has an agreement with the buyer and the seller may expect an assured demand for the buyer, and the buyer the moment switches from the one particular producer to another particular producer, in that case there may be have to pay penalty as per the buyer is concerned. The switching cost in that case also going to be high for the buyers. If the switching cost is going to be there high for the buyer, it is actually beneficial for the industry that we are talking about. So, that is one thing. Then sometimes what happens, the buyers have got may have lot of information. That means actually if you look at the information theory or information asymmetry symmetry, any player in the market benefit out of information asymmetry. Information asymmetry may not be healthy, may not be good for that matter, but that do exist in the market, and people do take the advantage of information asymmetry. That means what, one person has, another person does not have, and take the advantage of that and possibly go for a gain in the market for that matter. Now, it is quite essential from the seller's point of view that buyers do not know the cost structure of the particular product that is being procured by them from a particular company. Buyers should not be knowing that there are a number of who are the actual players involved. All those things buyers should not be knowing, then it becomes advantageous for the supplier as far as that is concerned. The moment the buyers come to know about different the cost structure, they come to know about different players that is there in the market as such, then they will have lot of bargaining power, and they can go for a lower price, because they know there are other players who are involved in this, they also know the cost structure. So, they can accordingly plan as such. So, if there is an information available more with the buyers, then it is a disadvantage for the industry from where the buyers are actually sourcing their input that matter. Then the next thing that you have, the buyer's ability to backward integrate, that is going to be the ultimate thing in as a threat from the buyers. If the moment the buyer themselves are going to integrate their value chain backward, that means they are going to procure on their own, they are going to have this input on their own, then it becomes a difficult proposition for the seller, because the buyer themselves have got the source. For instance, if there is a steel company, steel company may be sourcing the iron ore from a particular mining company, and it could be possible that the steel company has now bid for a mining iron ore mines and got the bid in their favor. What will happen? They will obviously stop procuring for the iron ore from the existing suppliers, they will have their own as such. So, anything that happens like that, where the buyer themselves are able to enter their input industry, then it becomes a bigger threat for the suppliers as such. So, that is something which supplier cannot do anything about. Rather, in that case, the suppliers have to go for alternate buyers for their particular products. So, that is something called the backward integration of the buyers facility as such. They go backward, means they go for raw material, they source raw material on their own, they produce them for that matter, and they no more depend upon the outside suppliers. That is another problem which can happen in case of bargaining power buyers, and bargaining power buyer is going to be high in that case. Next category of things that we have is the bargaining power of the suppliers. Now, like in fact, it is a corollary to the earlier discussion that we had called bargaining power of suppliers, bargaining power of buyers, is now is the bargaining power of suppliers, is exactly opposite here. Now, the industries on companies in a particular industry cannot be self sufficient from all the aspects are concerned. There could be different inputs that the companies may be requiring from different suppliers. So, it may be possible that there may be large number of suppliers for the inputs that the company require, and there may be very few number of suppliers for the inputs that the companies require. In that case, what will happen? If there are few large suppliers that dominate the market, then obviously it is going to be bigger problem for the companies. So, the moment we have got few number of suppliers, then what will happen? Their input cost is going to be driven by the suppliers than by the market, by the producers for that matter. There may be specific chemical, there may be specific mines for that matter, which may be only produced and sold by a particular group of entities. There may be specific technology which is available only few players. In that case, if that is the dependence, system of dependence is there for as far the producers are concerned, then it becomes a bigger threat for the industry. So, if the supplier numbers are very high, that means what will happen? At least there will be good quality products, because there will be demand will be there for that particular supplier which produces and sells the best quality product. At the same time, they will also go for this buyers will go for those suppliers who is supplying at a cheaper price. The moment more number of players are there, the moment very less concentration is there in the supplier group, obviously the price is going to be least for the inputs procured by the particular industry as such. That is one of the desirable for an industry, but it may be there, it may not be there as such. Then if for whatever reason there is no substitute for the input, for instance, steel industry cannot depend anything on anything else other than the iron ore as such. There is no substitute involved. But let us look at the furniture industry. But now if we look at the furniture industry, now we should has to have wooden furniture. Now we have got the plywood based furniture, we have got fiber or plastic based furniture, we have steel based furniture. So, it is quite possible for a particular thing one can migrate from one input another input, because the other substitutes are available in that particular sector. In a food industry also there may be a lot of substitutes could also be available. So, in that case switching from one input another input could be easier, but if there is something where one cannot but use only a particular input given a particular supplier, then it becomes a very difficult proposition for the existing industry. So, if there is no substitute for the input, then it is more like supplier dependency as per the buyer or the particular industry is concerned. But if there is a lot of substitutes are there for the inputs that the company is using for producing things, then it is a very good situation, because given a chance depending on the circumstances one can switch from input another input. But there is also one more thing one has to look at, that the switching cost should not be very high, otherwise it will be there may be lot of substitutes available for producing the same thing, but the switching cost in terms of changing the facility, the setup may be very high. So, that though the number of different things are available in the market, still the companies cannot go for switching from the input as such. That is what we talked about. The switching cost from one supplier to another supplier is very high. It becomes difficult for the buyer to switch from one input to another input, or one supplier to another supplier. Then there could be a possibility that the suppliers themselves integrate forward to get higher margin. Suppliers, when they integrate forward, means now instead of supplying to the present customers, they themselves start producing with their input as such. Looking at the earlier case we talked about, where the buyers go for backward integration, where the suppliers now go for forward integration. Another example that we talked about in case of buyer going backward for backward integration is that if you look at the shopping malls, if you look at the food bazaar, you look at the big bazaar, you look at the super stop, we find there are a lot of products sold with multinational labels. Established players products are sold. At the same time, we find there are a lot of private label items. So what happens actually, this particular shopping mall, for instance the big bazaar may be one of the example, where they source actually on their own, and they have their own suppliers, they have their own setup. Instead of depending upon others, they have their own shell manufacturing company, and where they produce and they only do that. They do not depend upon the outsiders. In fact, they could rather slowly move towards, suppose certain products which are not that differentiated, people do not go for that particular product because there are certain unique features are there, because this particular product is produced by a particular MNC or by a branded entity. Rather it can be produced by anyone, and one can go for switching from one to another supplier. Then what happens, the private label products are going to be they are from the, as far as the retail outlets are concerned. So that is another example where these retail outlets have gone for a backward integration. So they, instead of depending upon the suppliers, they have their own supplies in house as such. Similarly, suppliers themselves go for forward integration. Instead of selling through the retail outlets, the suppliers themselves establish their retail network. So instead of depending upon the retail outlets of other entries, or maybe big bazaars, maybe shopping malls for that matter, they have their own retail network, and in that case that is like a forward integration as such. Similarly, instead of supplying raw material to other players, they actually use their raw material and produce this thing that they are sellers of their raw materials actually producing. Instead of they supplying to them, they are now producing same thing what their customers used to produce. If that is the chance they are the suppliers are concerned, then as an industry what I am producing and selling, it may be difficult for me to sell tomorrow, because the number of buyers are going to be restricted. The buyers themselves are having their own things as such. Then buying industry could have low barrier to entry. So if the buying industry is having low barrier to enter the market, then is also going to be a disadvantage condition for the suppliers, or as per the existing industry is concerned. The moment they have a low barrier, obviously they will enter the market and force a very high competition, huge competition in the market as such. Next, having discussed different factors, different industry forces, 5 forces model, like substitutes, buyers, pressure from buyer, pressure from the supplier, then the rivalry among the competitors. Now we discussed to the different financial that we have in case of a particular industry is concerned. Looking at the talk about here is valuing an industry. Industry valuation is something like from there one can possibly go towards the company valuation. In the industry valuation, we will now talk about something like dividend discount model as a part of discounted cash flow. Then you have got something relative valuation approach, dividend discount model. Then you have got another model in this valuation is free cash flow approach. And in the dividend discount model, we have here is the ultimate form, the constant growth form of dividend discount model, where you talk about the price, which is nothing but expect dividend divided by cost of capital minus the growth as such. So, for as we have discussed earlier in the valuation classes, we have talked about this as a valuation of company. If this we are talking about price at a particular point of let us say 0, here we in this particular slide we are talking about I, the industry assets value, then the P 0 in the generic model we have is the D 1 divided by K minus G. The K is the return or the cost of equity, because the price is related to share, equity share. So, that is why it is, this is called cost of equity, and this is D 1 is expected in the next year. So, for example, if the company is expected to declare a dividend of let us say 10 rupees in the next year, and the cost of capital is let us say 10%, and then we have got 0.05 is the growth, and then the value of the particular share becomes 10 divided by 0.10 minus 0.05, 0.05. So, this becomes now 200. So, 200 rupees is the price of the share. Now, in the industry analysis context, we are talking about the overall dividend to be declared and paid in the particular year, in the coming year, by the all the companies concerned in that particular sector. So, one has to look at how do they expect dividend to be declared by the company and then subsequent the industry together, and then we have to look at the cost of capital. In that case, we will talk about the cost of capital is cost of capital from the industry's point of view, overall industry point of view, and let us keep in mind this cost of capital is going to different from one company another company in this particular sector industry. Similarly, the growth is nothing but the growth in the long term growth in the dividend that is going to happen in this future period to come, and this growth is talking about in the industry, and this growth can be different from one company to another company. So, that is one thing one has to look at, looking at the past performance of the different companies in this particular sector. Then from there one can look at the past performance, then expectation, and the same model that we talk about for company valuation, like for the cost of capital for the company's point of view, same thing can also be done for the industry's point of view. For instance, then as per the cost of capital is concerned, one has to look at this famous capital asset pricing model can be applied, CAPM, where you talk about the risk per rate of return, then beta and RM minus RF. RM is the rate of return from the market index, and RF is the risk rate of like government security yield or gilt security yield, or maybe treasury bill yield, depending on the time period is concerned. So, and beta we used to have beta as per the company is concerned. Now, one can also have the beta as per the industry is concerned. So, one can have a indices for a particular industry and can regress with return on this in a particular sectoral index on the return of the broad index like Sensex or Nifty, and find out the beta for the particular sector as such, and there we can have cost of capital. And subsequently then we need G. G is the growth rate. Growth rate is function of the retention rate. Retention rate means how much profit is retained by the business after declaring dividend, and then multiply the return on equity gives the growth as such. So, retention rate into return on equity. Now, return on equity, which is nothing but the net profit by equity. When we talk about that, so return on equity we talk about the net profit, profit after tax divided by the equity, which is nothing but the net worth. And in fact, we have discussed earlier this net profit to equity is a function of different things, like we have net income or net profit to sales, then we have multiply the sales by total assets, then you have total assets by equity. So, if you look at the sales get cancelled, total assets also get cancelled, what remains is net profit or net income divided by equity. That means, return on equity is a function of net profit, the profit margin, the asset utilization called turnover ratio, and the total asset by total equity nothing but the is known as financial leverage. So, these three things as a together, which is part of something called is called DuPont analysis, and these three things together are going to affect the return on equity. So, one has to look at how these three different things are there as per the industry is concerned, then one can forecast the return on equity for the industry as a whole. Then if you look at in this slide, we have different figures. We have taken three different indices like Apple goods, FMCG and IT. We find different ranges of asset turnover, which average 0.99, 1.48 over a period of time. These are this particular figure is average of different companies that particular sector, in that particular sector, and the ratio has been taken, and then the grand average has been found for different time period is concerned. Now, like that this has been done, we can see here return on equity for the capital goods is 19.12, which is 34.42 for an FMCG sector and 25.97 is for the IT sector. These data actually relate to certain number of small group number of companies. Once the number of companies change, the figures may change, but to just show that the different industries give different performance as such. Then if you can look at, we have plotted that, we can see here sales for total assets, we can see there is a more of stable, they have got almost stable thing as per different industries concerned, like this FMCG, this is capital goods, and this is IT. Looking at the next parameter that you have, we have got the capital IT industry. If you look at the profit margin is quite volatile over a period of time, whereas for the capital goods and the FMCG is more stable across the time period. Next we have is the return on net worth, where we see return on net worth has changed over a period of time, is increasing, whereas for the IT it is a lot of peak was there, big high rate of return of equity was there in the 2003-4, which has now substantially come down, whereas in FMCG is higher. This may be little aberration that FMCG is giving higher rate of return compared to IT, maybe it is because the particular sample that we have considered in this particular study as graph as such. Then we have the financial leverage. As usual, you can see capital goods have got high financial leverage, IT sector are supposed to known as low financial leverage, and the FMCG is inbuilt in capital goods and this one, so is and the IT. So, this is to say that the different industries have got different financial ratios as well. Now, the next thing that we have got the relative valuation measure index. In that case, we have plotted the price earning ratio of different sectors, and you can see that the here this is another is called healthcare, this is IT sector here. Then you have plotted some here like this, the Sensex and Nifty, their price earnings are almost parallel, as they are moving up, they are lower, subsequently go peak to September 2009, now in the May 2000 stabilize at some 20, something between 15 and 30, this is the price earning ratio of different industry indices. So, this is another thing, and as far as the global context is concerned, there are different industries which have got different input supplier across the world. So, for as far as industry analysis in global context is concerned, one has to look at the major producing and consuming countries for the particular industry, and how their economic environment, what are the different players in these global companies, and what are their financial performance, what are the different products produced, and different accounting differences may be there in different countries. One has to do the adjustments to go for a valuation ratio for industry. It can be comparable in one country another country. One has to do the accounting adjustments, and also one has to look at the exchange rate effect as far as the particular industry in particular country is concerned. Now, concluding our session, we talked about in the last two session industry analysis, we found that there is a lot of widespread dispersion in the performance of different sector. We also saw that the different industry have different risk phenomena, different risk is more or less depending on different industry. We also saw that valuation ratio is different from one sector to another sector, and also saw that essential to perform the industry analysis is a global scale, to have certain new things to observe in there, techniques to follow, and at this same time having done the industry analysis is also necessary that individual company analysis has to be done besides the industry analysis, and which we are going to discuss in the subsequent session as a part of company analysis. Thank you.